Hey, Colin. Hey, Anna. Great to see you.
Hi,
Hey, Jessica.
So 2023 data is probably almost in. How is 2023 shaping up to be?
Well, I mean, it was a pretty busy year, and it felt like quite a tough year, I think, with everything that was going on in terms of some of the stuff we'll come on to talk about. But actually, when I went back and looked at our forecasts from the end of 2022 for 2023, things weren't as bad as we thought. You know, economic growth here in the US held up pretty well, and even in other parts of the world where things were weaker, like Europe, it wasn't as weak as we thought it would be. So actually, 23 could have been worse.
I'm not sure if Anna's going to agree with that, but
You have the right instinct. I think on a macro scale, probably, we agree. But there certainly was a surprise from a rate environment perspective, and the banks were the ones who were definitely in the U.S. caught short from that.
Jessica, I think on the corporate side, it was not quite as bad, right?
Yeah, given the interest rate environment, inflation, I would say corporate credit held up pretty well. Corporate defaults came in almost 5%, not quite, which is about what we expected, and not that much higher than kind of the long-term average of around 4%.
Historically, where we've seen credit downturns, that default rate's jumped a lot higher.
Yes.
So if 5% is looking like the peak, it's a relatively shallow.
Yeah, it was double digits in past downturns, so 5% is not so bad.
But I guess a lot depends in terms of when we think about this year. Everybody's still obsessed with interest rates and what's going to happen, because that's going to drive an awful lot of how the environment unfolds.
Yeah.
At the moment, we're still expecting the first rate cuts from the Fed and from the ECB, probably in the second quarter. I know the market is maybe clamoring for things a little bit more quickly.
I think our base case was May.
Yep. Yeah, May for the Fed. The ECB might even move a little bit earlier, but probably in Q2. The interesting thing there is, even if we start to see interest policy rates come down, it's still going to be weighing on the economy, because we think that rates will end up eventually at about 2 to 3%, and that's where things are in balance and monetary policy isn't helping growth, but it's not weighing on growth. But it's going to take some time to get there. So even if we start to see rate cuts, it's still not going to be an easy environment from a policy perspective.
And it's definitely going to be a tight year from a bank funding perspective, even with the projected forward curve easing. The bank's losses are still going to continue, particularly I'm talking here about the U.S. banking system. And what that means is that banks will preserve their capital liquidity for only the best customers.
But if we've got the kind of banks understandably being a little bit cautious, I mean, Jessica, do you think that's going to be reflected in what we expect to see in the corporate sector? Because so many of our issuers are at least partly reliant on banks.
Yeah, I mean, clearly what happens in the banks will influence what happens in corporate credit. I mean, I think when we talk about private credit, came in very strong in 2023, and that was probably what prevented the corporate default rate from being higher, because a lot of the lower rated or lower credit quality companies were able to get funding.
It's fair to say that the leveraged finance market was pretty much shut down for any B-rated credits. So all these credits actually went into the private credit market, or anything that has a restructuring flavor.
And because so many corporates did not refinance in the last 18 months, there's a big refinancing wall coming up over the next 3 to 5 years. We see a lot of refinancing needs, both on the high yield and the investment grade side.
And private credit is more expensive. There's 150 to 200 basis points higher. Yeah, you can get more flexibility on terms. Mm-hmm. You can, pick your loan. The sponsor will infuse some capital, but so maybe that's not necessarily a default in the private credit market. I know you don't like to hear this. So it's very hard to compare the performances for that reason.
In terms of how that then relates, I mean, you talked a bit about refinancing walls, but some of not a lot of that's in 2024, right? And in terms of coping with the higher interest rates, we've already seen that happen a bit in spec grade, is that right?
Yeah, so 2024 from a refinancing perspective is not huge, but it really does start ticking up in 25 and 26. And remember, companies they can't wait to the last minute to refinance. They're usually, we're looking at companies to refinance about at least a year ahead of a maturity. Okay. And you're right, interestingly enough, the speculative grade companies are mostly financed through floating rate debt. And so they've really absorbed a lot of the shock from interest rates. But on the investment grade side, most of them are funded through fixed rate bonds. And a lot of them refinanced in 2021 when interest rates were historically low. So they actually haven't even felt the pinch of higher interest rates yet. As they go to refinance in 2025 and 26, they will also feel kind of this delayed impact from the higher rate environment. So even though rates are coming down, many companies will still see their interest expense continue to rise for the next several years.
I mean, we're not going back to zero. That's our house view. So people have got to adjust. But I guess hopefully if we're doing our jobs well, these companies that are investment grade that still have to cope with the pass-through, we think they'll be able to do it. And that's why they're rated where they are.
They are largely able to absorb the increased interest expense. And again, our ratings are forward-looking. So we're looking ahead at every company, their bond maturity schedule, and we're already incorporating what that increased interest expense will look like. And we have taken a lot of ratings down, particularly, REITs, real estate investment trusts, real estate companies. They're highly levered, very sensitive to interest rates. And even if they look okay today, we know that it's going to be a credit deterioration environment for them over the next several years.
And we did the same thing in terms of the debt rates that we rate in the financial institutions group.
Sure.
We have negative outlook, continued second year on them, and we did take ratings down and negative outlooks as well for the same reason.
I mean, this focus on the kind of real estate investment trusts that we rate begs an obvious question kind of more broadly about property. I mean, Anna, what are we seeing on the kind of commercial real estate side in terms of the risks there?
Our biggest concern is office. We all had got used to working from home, et cetera. Digitalizations, particularly some big metro centers like San Francisco, Seattle, New York, we're hearing even Washington, D.C., it's quite challenging. And what we've seen is that the situation that the smaller banks are, they need to preserve capital liquidity, and they're going to have a refinancing wall of roughly a third of these loans coming due this year. So who is going to refinance the wall? This is where private credit is raising capital to be able to obviously step in, but they're not going to step in at the full price the banks are holding these loans. So that's going to be probably leading into another year or two, at least, of a painful performance for the smaller banks' balance sheets where we have concentration in commercial real estate.
So we talked about interest rates. What else are we looking forward to in 2024? What's our general outlook?
So in terms of our global economic growth outlook, we had growth of about 3%, a little bit less last year in 2023. We're expecting something closer to 2% this year, but then it should pick back up again, probably to about 2.5% in 2025. So this might be the kind of weaker patch for the global economy, even though there's a lot of regional differences in there. One of the big questions that we're focused on is, of course, whether inflation really is going to go all the way back to target. We've seen, I don't want to call it the easy stuff, but when you measure inflation, it's all about the kind of price level compared with the previous year. A lot of the big jumps in prices that we saw in the past are now dropped out of that inflation measure. And that's why headline inflation has come back down a long way in most parts of the advanced economies. But what we're going to learn now is just how ingrained that inflation has become more broadly in terms of what's happening in the labour market, what's happening in the service sector, and how hard it will be for central banks to get all the way back to 2% targets and stay there. I think we're going to see a bit of volatility.
Well, what worries me is that the forward curve has been quite wrong, as we know, and a lot of the markets price based on the forward curve. Yeah. So the markets get very positive about what's happening, and that they're all expecting maybe 100 basis points or more rate cuts, and the price assets based on that. And that does not necessarily happen. We are going to be, seeing more volatility in capital markets, and particularly more volatility in the treasury market, which is not healthy.
No, and that kind of volatility just kind of fosters uncertainty, and that's one of the things that weighs on particularly like the lev fin market, right? Yeah. Where as a company, you know what your maturity profile is, and you want to have a great story about what you're doing, but you're also dependent on, is the market open for you or not? I mean, hopefully, all forecasts are wrong, I've said that many times, but hopefully over the course of this year, if we start to see policy rates get cut a bit, that will lend a little bit of support to markets, because it will just take a little bit of that uncertainty out. But as I said before, it's still going to be a long process.
Yeah, and I think we still haven't seen the full effect of quantitative tightening on banks' balance sheets. We have an excess of trillion deposits that were created as part of COVID, and only Some of it has left the system, not everything, and there is a competition with the money market funds that has eased up over the last 6 months. That may not necessarily be forever. So it's, I think, one of the biggest wild cards, if we're kind of moving into the downside risk, is really what happens with the funding strains, what happens with competition for deposits with the money market funds. Of course, reinflation, as we talked about, and then we have macro and geopolitics.
It's a long worry list, isn't it? But I mean, Jessica, I'm keen to get your take on what we're expecting on the corporate side. Is it kind of a pretty sticky picture, or is it a bit more mixed?
Yeah, it's mixed. So we just published our 2024 outlooks, and it's very mixed. So we're stable in North America and Asia, except China.
Right.
We're negative in Europe, Middle East, Latin America, and China. So, for example, in Europe, we're a little bit more concerned about the consumer spending side of things than we are in the US. Energy prices are higher, and they also, not only does it pinch the consumer, but the companies who are operating there and are very reliant on input costs, such as energy prices and gas, they're at a structural disadvantage versus their competitors in the US that have lower gas prices. So we're concerned about that. We're concerned about proximity to the conflict in the Middle East and obviously Ukraine, Russia. So that is not as a stable picture as in the US. China, we're continuing to see fallout from the property sector. And that's not just going to impact China. Obviously, that's a global impact. Many companies and industries around the world service the China property sector and will be, feeling the fallout.
And that's one of the key drivers why we also have negative outlook on the Chinese banks and as well as slowing growth. But we have even more negative because we have negative outlook on the European banks and on the U.S. banking system. I think where it's interesting, it's really the emerging markets and particularly countries that have eased up earlier the cycle where inflation kind of slowed down. We're talking about Brazil, we're talking about Indonesia, India. These are big economies, little bright spots, if you will, out there. And then the Gulf. We just talked about higher gas prices. That's helping the Gulf banks. So that's another area where we're more constructive.
Yeah, it's interesting because I think emerging markets generally kind of responded a little bit more quickly to the inflation shock. A lot of them raised interest rates earlier, and they managed to get inflation down a bit quicker as well. So there are some of these major markets where policy moved into kind of easing mode quite a while ago. We're still waiting for that in the US and Europe and elsewhere. I think the challenge is, even with that slightly more constructive environment, we're not expecting emerging markets as a whole to kind of accelerate in terms of their economic prospects. Our growth forecasts for EMs for this year are pretty much the same as the forecast for 2025. So it's hard to see things getting better from a macro.
And they do depend on global financing conditions as well.
Yeah.
So it all depends what happens in the global capital markets. We just talked about that volatility. It happens with the banking systems. So certainly we have a little bit of a calm there, but not necessarily forever.
No, I mean that's what keeps us employed, right?
Yes.
There's always new risks and new things to be thinking about.
But it was a great discussion.
Yes,
Thank you
great
all.
to see you.
Thank you very much.
We'll see what 2024 brings.